Are you a fan of dividends? Do you love to see those dividend payments consistently rolling in and growing each and every year? Well, how about an ETF designed specifically for this purpose and has outperformed the S&P 500 since the underlying index's inception in 2005? Hey guys, this is Nick with Nick Does DGI and welcome back to my channel. I hope you are having a wonderful day and are staying safe out there. Stay tuned as I go over the perfect dividend growth ETF and whether I think it is a buy in 2021. I want to talk about the one and only dividend growth ETF, ticker symbol NOBL or NOBL. For full disclosure, I do not have a position in this ETF at this time of recording, but for what this fund is and what it offers, I'm bullish on this ETF. And as always, these videos should not be construed as financial advice, and please do your own diligence. Before we can start looking at this ETF, let's quickly go over what dividends are. Dividends are distributions of some of a company's earnings to a class or classes of its shareholders. The amount or frequency of its dividend payouts are to be determined by the company's board of directors. There are different kinds of dividends, but in most instances, we're talking about cash dividends or cash paid directly to shareholders based on how many shares of common stock a shareholder holds. ETFs, or exchange-traded funds, is a type of security that can be thought of as a basket of stocks, bonds, or other assets. ETFs are publicly traded on the stock market, allowing for liquid buying and selling. And when a given ETF holds dividend-paying stocks, the ETF fund managers will determine how much and when the ETF will pay out its proportion of dividends of the underlying securities. But now that you are all caught up to speed, offered by ProShares, NOBL is the only ETF out there that exclusively tracks the large cap S&P 500 Dividend Aristocrats, a select number of high quality companies that have raised their dividends for at least 25 consecutive years. Over a quarter century of uninterrupted dividend growth is no small feat. As of the end of 2020, there were 65 total companies in NOBL with an average of 41 years of consecutive dividend growth. NOBL currently trades around $85 as of this time of recording and offers a 2.25% dividend yield. Dividends are paid quarterly and the net expense ratio is 0.35%. Average price to earnings ratio is 22.88 with an average weighted market cap of 78 billion and 47. Since Dividend Aristocrats raise their annual dividend payouts every year, it only makes sense that NOBL ETF payouts also increase yearly. Over the past 5 years, the fund has averaged an annual growth rate of 12.34%. Here are 10 of the most accomplished holdings of NOBL with over 50 years of dividend growth history. To think that well-known blue-chip companies such as 3M, Coca-Cola, Colgate, Johnson & Johnson, Procter & Gamble, and the likes have been growing their dividends since 1963 is quite astonishing. Through the oil crisis of the 70s to the dot-com bubble of the early 2000s, housing great financial recession of 2008, and most recently, the 2020 pandemic recession. Notice how nearly half of NOBL are in certain sectors like industrial, consumer staples, and materials, where those respective industries are less likely to change year to year with great predictability and stability. The NOBL ETF may be appealing for a number of reasons, such as stable earnings and strong balance sheets. Dividends are often paid out from a company's profits and can only be viable long-term if a company can consistently grow its earnings year over year. There are companies that will try to maintain dividends by taking out debt to do so, but that is not sustainable and is a dividend trap in the making. Second, dividend growth history is indicative of a company's long-term commitment to returning profits to shareholders. A corporation, through its directors, owe duties of care and loyalty to the company's shareholders and to act in the best interests of the corporation. To know that a company will prioritize increasing its dividend year after year shows that management is doing its job, and investors can rest easy knowing that they are a priority in both the company's short-term and long-term business operation. Third, a proven 25 plus year dividend growth history is definitive proof of durable business models and long-term competitive advantages. As previously mentioned, the ability to withstand new and emerging disruptors as well as economic recessions is itself a competitive advantage or moat. Case in point, during the midst of the pandemic recession, we saw well-known non-dividend aristocrat companies like Wells Fargo slashing its dividends by 80%, or Simon Property Group cutting its dividends by nearly 40%, or Carnival entirely suspending its dividend as it grapples with the effects of the pandemic. It only takes one economic downturn for a company to experience financial struggles, and as a result is forced to reduce or completely suspend dividend payments. Anytime I analyze a prospective stock or ETF, I like to see how it compares to the broad market index like the S&P 500. I usually want it to fare comparatively even unless it's for a specific purpose, such as a high yield income or bonds. Nonetheless, it's safe to say that NOBL can hold its own weight. Since the underlying Dividend Aristocrat Index's inception in 2005, it has actually outperformed the S&P by about 1%, an annualized total rate of return of 11.07% to the S&P 500's 10.06%, all while with a lower volatility of 15.75% to 16.54%. That is only possible because of the inherent holdings of Dividend Aristocrats versus more volatile technology or small cap growth stocks. Since 2005, the index has been able to capture 91% of the market's gains, yet experienced just 79% of the market's losses, leading to its long-term outperformance. Furthermore, in 4 of the 5 worst quarterly drawdowns, the Dividend Aristocrat Index outperformed the S&P by an average of 4.13% and has outperformed in 8 of 10 subsequent periods. Now, would I buy this ETF in 2021? Well, it would depend on what kind of investor you are. If you are a more passive investor who don't want to get involved in the nitty-gritty details of choosing individual stocks, then NOBL might be the ETF for you, upon further research of course. You are paying a slight premium in the form of the 0.35% expense fee, but you'll be holding a quality outperforming ETF of all the S&P 500 Dividend Aristocrats. On the other hand, if you like to be more hands-on with your investments, there's nothing stopping you from creating your own 65 position Dividend Aristocrat pie on investing platforms such as M1 Finance. Referral link in the description below. However, one downside is that whenever the NOBL ETF rebalances its portfolio every once in a while, you will have to manually make adjustments. But nonetheless, I'm glad to see that there is a dividend ETF that embodies the time-tested investing strategy of dividend growth investing. While the market and media continues to focus on growth and new technologies, I believe that market cycles are cyclical and will come back to love dividend-paying companies. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. I am just an ordinary guy posting his opinions onto YouTube because I love dividends, stocks, and personal finance. If you found this video helpful, please consider clicking the like button and subscribing to my channel. This helps with the YouTube algorithm and gets my channel noticed. Hit the bell notification to receive the latest alerts, and all engagement is much appreciated. Until next time, take care.